In this session, let's start looking at the key revisions to the Basel II market risk framework. If I look at on a broader scale, the key objective behind it is to improve. Why should the revisions occur? To improve the bank models, especially the calculation models for market risk, bring about an improvement in them by considering the additional risk factors. So till now the bank models were not including the migration risk and all. So and even come bring out with some kind of additional factors to price securities. So bring out with an improvement, especially with respect to the specific risk factors which are associated with every instrument, bring them out and incorporate them as a part of the pricing process. And even from an accounting dimension, these models are working, especially with the trading book, the position of the trading book. So when we are talking about the current guidelines, especially with respect to valuation, it is suggested that all positions should go with a fair value accounting, no historical value here. And they are subjected to a fair value accounting, and whatever was the most recent valuation that has been performed on that asset, that is being used to determine and assess the liquidity position. So that is one major objective as a part of modification to the current Basel II framework, especially when we are talking about a capital charge. We have to now look at from the dimension of the general market, the general market risk based capital charge, and we are also talking about a specific risk. The mechanism that is being used, at least for the capital charge for a general market, whatever we have used earlier, the 10-day var, 99% confidence level, whatever was the mechanism that we have used, as well as a stressed var. These are the mandatory requirements as per the Basel for the general market risk. Even when you are computing the charge for a specific risk also, we can apply the similar kind of a process itself. And even the multiplier that has been used, all these things even for a specific risk will be the same as that of the market risk. And from a bank standpoint, they have to cover any kind of IRC, incremental risk charge, that comes, because because the specific risk could be either more riskier than the general market risk. So the bank has to cover any kind of incremental capital charge that comes up because of the usage of this kind of a model. So even for a specific risk, the process that comes out to be the same. The banks can either use the standardized kind of an approach, or the internal ratings kind of an approach, which again they both depend heavily on the external credit ratings. So the similar kind of a process is being followed even for a specific risks also. So with respect to some specific risks, we see that there are some kind of weightages that are being defined, especially depending on whether the position is whether the position is a securitization exposure or a resecuritization exposure, and depending on the credit rating associated with it, we see that we apply an appropriate risk weight. Let's say from AAA to double A minus, probably a securitization exposure will have a 20% weightage, whereas a resecuritization will have a 40%. A plus to A minus kind of a rating will carry 50 and 100 respectively. And if the underlying securitization is a triple B plus to triple B minus kind of a rating, then you apply 100 and 225 here, and probably a double B plus to double B minus, you apply a 350% as well as a 650% here, and anything that is less than B plus and below, we are treating it as a deduction itself. So for any position which is having a rating B plus or below, especially we are doing them as a deduction itself. Means a capital that is equivalent to the unrated equity securitization tranche must be typically held. So that is one major modification that has come out, means the deductions are going right from a B plus kind of a rating, and even an unrated position also is getting exposed to a heavy deduction itself. Uh, but the only difference is when we are calculating the general market risk, probably we were excluding these deductions, but when we are going with this specific market risk, even these deductions also need to be counted for. Now, one major important factor as a part of this process is whatever the risk factors that have been used to price the security, right? Whatever the risk factors, probably if you have considered the spot rates with respect to the interest rates, or if you have considered some market related factors to price equity securities, whatever are those risk factors that are typically considered as a part of the pricing mechanism, the same set of factors should be used to compute the value at risk also. This is one major thing that has come out as a part of this modification exercise. And at the same time, along with that individual security related risk, even the correlation related risk or the basis risk, which is difference between the two positions, the spot and the future positions changing at different rates over different time period, causing a kind of a basis risk. So even the model should definitely incorporate the correlation risk as well as the basis risk also. They have very clearly come out that whatever the risk factors that you are considering, right, especially when we are talking about bonds or any kind of interest rate dependent kind of securities. So if you have used yield curves and all for pricing your bonds, the same logic will go even for computing your value at risk also. Similarly, foreign exchange should be considered as a risk factor, especially if you have done that as a part of your bond pricing process. Even for computation of the VAR also, the foreign exchange risk needs to be considered as one of the important factors. Similarly with the equity, similarly with the commodity, whatever are the risk factors that are considered for pricing the security, the same has to go in the computation of the bar levels also. That is one more thing that has been introduced as a part of the key modification. And there is one more dimension with respect to a stressed var. Probably you should look at it as a maximum of the recent var, whatever you have come out with, latest available stressed var, and the stressed var average stress var over the last 60 days, which will be multiplied by 3 plus a factor, and this factor is dependent on the back testing, depending on number of exceptions that come out as a part of your back testing process, which we have discussed under the market risk. So the minimum would be 3 and it can go even up to 4. So the stress VAR, it has to be calculated on a weekly basis. And what is typically being said, you have to combine the current portfolio performance data on a 10-day. The computation is happening as a 10-day 99% confidence interval by considering even your current portfolio position itself. And typically you have to take the maximum of the stress VAR as of the recently calculated, which is of the current period, or the average stress VAR, where you are multiplying it with a multiplication factor which will go as 3 plus some f, and this f is based on the backtesting model, where depending on whether you are in the green zone, whether your model is in the green, yellow or red, appropriate multiplication factor is applied, and based on that, whichever is the higher, that will typically go as a part of your stress VAR. So here it is coming out very clearly that the capital requirement should be higher for the stress VAR. So it's the higher number of the latest available stress VAR, or even the average calculated over the last 60 days. And whatever is the multiplication factor, it is coming from individual supervisory authorities based on the typical backtesting framework that has been implemented. And so when we come to this market risk capital requirement, the market risk capital requirement is directly coming out as the maximum of the VAR, the recently computed VAR. Again, we are taking the multiplication factor, a VAR average. Exactly the same process. And at the same time, we are also taking the SVAR, the stressed VAR also, again, which is a maximum between the T minus 1 period and a multiplication factor times SVAR average over the last 60 days. So this would be the total market risk capital requirement, where you will be taking the normal VAR, whatever is the capital that is coming out because of the normal VAR, as well as the stressed VAR. It's a summation of both the regular VAR as well as the stressed VAR measures, right? So that is one more important thing that has come out as a part of this process. And now talking about the various disclosures that are necessitated from the banks, I can look at the qualitative as well as the quantitative disclosures that have to come out. When I look at qualitative disclosures, especially with respect to the incremental risk capital charge, it has to include whatever are the methodologies the bank has adopted to compute the liquidity levels. What are the various mechanisms? Did it use LVAR, or whatever are the mechanisms that are being used by the financial institution to compute the liquidity levels? What was the procedure it has done for creating the model as well as validating the model, and the mechanisms that are used to meet the capital assessment criteria. So all these things have to be mandatorily looked at in the disclosures, qualitative disclosure aspect. And when it comes to the quantitative based disclosures, especially for trading portfolios, the quantitative disclosures, especially when they are internal rating based models that are being used, you have to very clearly indicate what is your high value, mean value and the low value for all. For VAR as well as the stressed VAR, you have to clearly highlight these values over the whatever the period we are considering, and along with that the outliers which have been considered, and associated incremental risk capital charge. All these things have to be mandatorily disclosed as a part of the quantitative disclosures. And from a bank standpoint, they have to maintain a proper procedure for computing the adjustment, whatever the adjustment they are doing to the less liquid positions, current value of the less liquid positions, right? How are they modifying the value of less liquid? If it is a highly liquid kind of a position, obviously there is a trading that is involved in it, and obviously the value of it changes on a dynamic basis. But if the position is less liquid, what is the mechanism they are coming out to update the current value of those positions, as even though the that position is marked to or not, marked to model or not, or even if it is obtained through a third party valuation mechanism. Irrespective of any of these things, a proper disclosure has to happen with respect to the mechanism that is being used by the bank to typically adjust the current value of the less liquid position. So these are some of the important regulatory changes or revisions that have come to the Basel II market risk framework. It is important for us to understand how the risk patterns from a market risk dimension are changing to get a better idea of the same. If you have any further queries regarding this, you can get back to me by giving me a call on the number that I have given below, or send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.